Ladies and gentlemen, welcome to the Q4 and FY2024 earnings conference call of Lumax AutoTechnologies Ltd. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Jain, Managing Director of Lumax AutoTechnologies Ltd. Thank you, and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. A very warm welcome to our Q4 and FY24 earnings conference call. Along with me on this call, I have Mr. Vikas Marwah, CEO, Mr. Sunil Koparkar, Managing Director, IAC India, Mr. Sanjay Mehta, Director and Group CFO, Mr. Raju Kheskale, Group Head Manufacturing and Corporate Planning, Mr. Naval Khanna, Corporate Head Taxation, Ms. Priyanka Sharma, Head of Corporate Communications, Mr. Ankit Thakral from Corporate Finance, and SGA, our Investor Relations Advisor. The results and presentations have been uploaded on the stock exchange and the company's website. I do hope everybody has had a chance to go through the same. To begin with, I would like to reflect on FY24, which has been the most successful year in the company's history in terms of financial performance. We witnessed a remarkable revenue growth of 53% on a year-on-year basis, at rupees 2,822 crores, and also the highest ever historic profit of rupees 413 crores EBITDA. This achievement is a testament to our commitment to delivering high quality, diverse automotive technologies and solutions to our customers. The growth was driven by strong sectoral tailwinds, with vehicle sales across nearly all segments returning to pre-pandemic levels. This resurgence was fueled by robust demand for passenger vehicles, driven by customers' aspirational desire towards premium personal mobility. A major highlight of the year was the rebound in sales of two-wheelers, which had been experiencing a slowdown since the pandemic. We anticipate that this segment will continue to grow and outperform on the back of launch of multiple high-end models by major OEMs. However, it is worth noting that the tractor and commercial vehicle segment experienced subdued performance due to weak monsoon conditions and muted private capital expenditure during the year. Despite these challenges, FY24 emerged as one of the best years for the industry overall. Mirroring the performance of the auto sector, the auto ancillary sector has also achieved an unprecedented turnover of INR 5.6 trillion in FY24, based on the data released by ACMA. This was driven by several factors, including strong vehicle sales within the country, a thriving aftermarket, and consistent exports. Additionally, the trend of premiumization seen across various sectors is increasing the value per vehicle. There is a growing demand for high-end vehicles, particularly in the passenger vehicle and two-wheeler segments. This trend presents a valuable opportunity for ancillary players like us to increase our content per vehicle and enhance our market presence. The growing inclination of consumers towards high-end features and cutting-edge technologies in automobiles is facilitating the development and provision of increasingly complex and sophisticated components by Tier 1. Speaking on Lumax Technologies, this year marks the successful completion and integration of the IAC India business, which is poised to be a significant growth driver for the company. And we are confident that its momentum will continue, fueled by the addition of new customers and the expansion of our wallet share among the existing customers, which will enhance overall capabilities and position us to leverage synergies, optimize operations, and deliver superior value to our stakeholders. Coming to our joint ventures, Lumax Mannoh and Lumax Cornaglia have continued to demonstrate strong growth, contributing significantly to company's overall growth. Other smaller joint ventures are also making notable progress towards a turnaround in line with our business strategy. These joint ventures are poised to become key drivers of growth as we move forward. We are confident in their potential to enhance our market position and contribute to the sustained expansion of the company. Additionally, during the year, with an aim to boost our aftermarket presence, we also announced the partnership with Germany's Blue Chem Group, a leader in innovative automotive car care solutions, to offer Indian consumers world-class automotive care products. Our company continues to be the preferred partner for major OEMs in the country due to our ability to locally design, develop, and manufacture high-end products as a full system supplier. We consistently demonstrate our capability to forge strategic partnerships and expand our product range, reinforcing our position as a key player in the industry. Speaking on the performance entity-wise, the standalone entity caters to integrated plastic modules, aftermarket business, chassis and swing arm for two-wheelers, trailing arms for three-wheelers under the metallic business, and two-wheeler lighting. The standalone entity has contributed 47% of the total consolidated revenues for FY24. During the quarter, the Bangalore plant of the company received the Best QCD Performance Award at Honda Motorcycle India's annual supplier convention held in Mumbai in March 24, and the VAVE Award at the Maruti Suzuki Vendor Conference in April 24. IAC India, the recently acquired 75% subsidiary, which is a Tier 1 interior system supplier to key automotive OEMs in the country, including Mahindra, Maruti Suzuki, Volkswagen India, and Volvo Eicher Commercial Vehicles, contributed 31% of the total consolidated revenues for FY24. The company received the New Path Development Award at the Maruti Suzuki Vendor Conference in April 24, and the Best Cost Management Performance Award at the Mahindra Supplier Excellence Awards in February 24. In the current quarter, the company has started supplies to the newly launched Mahindra 3XO model, which is offering premium interiors and is in very high demand. The company also for the first time has added Tata Motors as a new customer for supply of console based on the long-term relationship between Lumax and Tata Motors, the SOP of which is expected in Q4 of FY25. During the quarter, IAC India, which was acquired through Lumax Integrated Ventures Private Limited, has been merged with Live with appointed date of March 10, 2023. Lumax Mano Allied Technologies, the 55% subsidiary which manufactures manual, AMT and automatic gear shifter systems and has a market leadership position, contributed 12% to the consolidated revenues. During the quarter, the company received the Financial Prudence Award at the same Maruti Suzuki Vendor Conference in April 24. Lumax AutoTechnologies, the 50% subsidiary manufacturing air intake systems and urea tanks, commanding 100% share of business with Volkswagen and Tata Motors, contributed 6% to the consolidated revenues. Lumax Ituran Telematics Private Limited, the 50% subsidiary, has successfully commenced supply of telematics parts to Daimler India in the current quarter. As a result, the revenue is expected to grow significantly in the next financial year. Lumax Alpine India Private Limited, the 50% subsidiary for the manufacturing and sale of electric devices and components, including software related to the automotive industry, has contributed 1% of the total consolidated revenues. We have an order book of rupees 110 crores and continue with aggressive targets for this joint venture. The company did receive recognition for quick resolution of market feedback from Maruti Suzuki India. During the current quarter, the company has acquired remaining stake in Lumax Ancillary Limited, and LAL has become the wholly owned subsidiary of the company with effect from January 25th, 2024. Further, subsequent to year-end on May 27, 2024, the board of directors of the company has accorded its consent for proposed merger of LAL into the company with April 1, 2024 as the appointed date. Lastly, on the order book front, the company has a healthy order book of more than rupees 900 crores, out of which 200 crores is for standalone entity mainly of plastics and metallic divisions, rupees 300 crores for the joint ventures, out of which 200 crores is for the new joint ventures and 100 crores is for the matured joint ventures, and rupees 400 crores for IAC India. Out of the total 900 crores, 90% is new business. 30% of the order book value will mature in FY25, 55% in FY26, and the remaining 15% in FY27. The EV contribution is approximately 40% of the total order book. We continue to deeply engage with our customers to constantly win more businesses across models, thereby increasing our order book. Now, I would like to hand it over to Mr. Sanjay Mehta, Director and Group CFO, to update you on the operational and financial performance of the company.
Good afternoon, everyone. Let me brief on the operational and financial performance for Q4 and FY24. For FY24, integrated plastic modules contributed 47% of overall revenue, followed by aftermarket at 14%, gear sector at 12%, fabrication at 8%, emission at 6%, lighting products at 5%, and others at 8%. Passenger vehicles contributed 48% to overall revenue, 2 and 3 wheelers at 24%, aftermarket at 14%, CV at 9%, and others at 5%. For more detailed operational highlights, one can refer our investor presentation uploaded on the exchanges and company website. On financial highlights, the consolidated revenue for Q4 and FY24 stood at rupees 757 crores and 2,822 crores respectively, up by 54% and 53% over the corresponding period. This is the highest ever single quarter and yearly revenue. It includes revenue for IAC India of rupees 886 crores and 30 crores for Lumax Ancillary. 2 months revenue of Lumax Ancillary post 100% subsidiary with the company. EBITDA margin stand at 14.5% for Q4 as against 12.6% for the Q4 corresponding last year, up by 190 basis points. Absolute EBITDA for Q4 FY24 stood at 110 crores, growth of 77% on year-on-year basis. For FY24, EBITDA stood at 413 crores, which is the highest ever registered EBITDA for the company with margins of 14.6% compared to EBITDA of 224 crores at margins of 12.1% corresponding period of the last year, up by 250 basis points. PAT before minority interest for the quarter stood at rupees 51 crore as compared to 24 crores in Q4 FY23, a growth of 116%. The margins stood at 6.8% for the quarter due to the tax benefit of finance and depreciation, cost amounting to approximately rupees 7 crores on IAC acquisition post merger with Live, as was explained in earlier investor call. For FY24, PAT before minority interest stood at 167 crores, grown by 50% year-on-year with a margin of 6%. The tax rate for the full year is 26.4% and is likely to continue in the same range in the future. The capex during FY24 is 111 crores, which includes 33 crores on account of leasehold assets. The actual capex therefore is 78 crores. The company is sitting on a healthy free cash of 396 crores. The net long-term debt as on 31st March 24 is 15 crores. With this, we open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. Participants who wish to ask a question may press star and 1. The first question is from the line of Neeraj from Lumax Properties. Please go ahead.
Yeah. Hello, sir. Thank you for the opportunity. If I look at our annual numbers, right, if I exclude the acquisition part, I believe we grew top line by around 8% and EBITDA by around 9%. And I understand things changed during the year, but when we started out, the guidance was around, between 15 to 20% kind of growth. So can you please elaborate what happened throughout the year and what are our expectations for the next year?
So thank you. So your numbers are correct. Without the acquisition of IAC India, the growth numbers are 8%. There were 2 to 3 fundamental reasons why the earlier guidance of, let's say, double-digit 15% plus growth were not fructified in the last financial year. Number one was the aftermarket. I think in aftermarket, not just for Lumax, but across pretty much all tier ones and other peers, we see that there has been either negative growth or a very muted single-digit growth. And this is largely because of poor cash realizations or income realizations from the aftermarket. So we, as a matter of principle and good financial prudence, we make sure that we do not push the aftermarket revenues just to get the revenue going. So in line with that, we altered our aftermarket sales, and that's why we grew at about 8% for the year versus the earlier guidance. So that's one of the reasons. The second was that Bajaj Auto has had a massive change in the product mix based on their earlier guidance. The Pulsar platform is perhaps only platform which has grown significantly to the overall Bajaj volumes, and that is a platform where Lumax Technologies does not necessarily have a strong presence in. We are talking with Bajaj Auto to how to get onto that platform in the forthcoming, let's say, quarters. However, these were the 2 fundamental reasons why without IAC India, the growth percentages were muted.
Understood. And sir, what's our guidance for FY25?
So I would say that FY25 at a consolidated level, I would still say that the growth would be anywhere around 20 to 25%. This includes IAC. Of course, the IAC growth is expected to be somewhere between 15 to 20% on the back of new model launches and certain other incremental organic growth of certain recently launched models. And again, the standalone entity would probably also grow in a similar vicinity of about 15 to 20%. The subsidiaries will probably grow at a much faster rate. I think overall we are expecting that growth to be maybe around 40 to 50%. Again, it's a smaller base, but from a growth rate, we are looking at a much faster growth rate of the subsidiaries and the joint ventures.
Understood. And sir, on slide number 31, we mentioned that our net debt is 16 crores. So this only takes into consideration long-term debt, but if you include short-term debt as well, so what's our net debt currently?
So the net debt, if I will take this, is 285 crores net debt, including that working capital limit. So the bifurcation is that long-term debt is around 411 crores, exit figure, and the short-term loan is around 270 crores, the working capital loan. I can say we are carrying the free cash of almost around 400 crores.
Understood. And sir, I understand from our previous discussions that, when we bought IAC, we entered into some kind of a loan agreement which we had to, keep on the books for 18 months. And when we have a lot of cash on the books, so can we repay those debt when 18 months period is over?
So this is the big debt, and that still is there that period 18 months somewhere it will be up to September. So we are negotiating, and I think the way forward, whatever the interest cost that we have taken from NBFC, that will be further restructured.
So in summary, in FY25, can we see substantial reduction in our finance cost? Will that be a correct assumption?
No, I think because the substantial reduction in finance cost may not be there, but yes, the net debt, definitely there is a reduction in the net debt, total debt.
Okay, understood. I have a couple of more questions. Maybe I will come back in queue. Thank you so much.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Amit Hiranandani from SMIFS Limited. Please go ahead.
Hi team, thanks for the opportunity and congrats for the strong set of numbers for the financial year. Sir, my first question is basically, can you please help us with the revenue, EBITDA and PAT number for all the subsidiaries for FY24, please?
So the revenue numbers have already been were there in the opening speech of Mr. Anmol Jain, and the subsequent EBITDA and PAT numbers, we will be uploading the financials of all the subsidiaries in, say, for example, next month or maybe in the July month. So, but that numbers we can anyway share now offline.
Sure, I'll ask offline as well. And sir, if possible, can you at least give a broad number for at least for the 3 entities, ISC, Manoa and Cornalia, the revenue, EBITDA, PAT?
So the ISC India revenue is 886 crores for 12 months with EBITDA of 175 crores.
And Manoa?
And Element revenue is 53 crores with 17% EBITDA.
And lastly, Cornalia, please.
157 crore revenue at 18% EBITDA.
Great, sir. Sir, my next question is on the ISC India. And first of all, congratulations for adding Tata Motors as a new customer here. And can you just please give a broad outlook for 2 years for this important entity? And also, sir, we were supposed to add a capacity in ISC India. So what is the status here, current utilization level for the same and margin outlook for this important entity, please?
So I'll just quickly give my comments and then maybe I'll request Sunil to give you a little bit more detail. I think we've always said that once we got into the strategic inorganic growth, the idea was to take the competency of ISC India and expand into certain other customers and improve our wallet share across customers. Clearly, Tata Motors entry is a first step towards that strategic direction. Second was also to see how we can cross-synergize and sell a basket of products to our customers. For that, I think, again, ISC India is already working in the advanced stages of probably developing and integrating the interior lighting along with the Lumax engineering team. I think going forward, I would still say that the CAGR of ISC India would probably continue to be in the double-digit space. And again, from an operating margin, I think I would still say that anywhere upwards of 15% EBITDA would be a sustainable number going forward over the next 2 to 3 years, obviously on a top line growth of, as I said, more than 15% CAGR. But Sunil, maybe I'll just hand it over to you to have a little bit more understanding on the expansion part and what you entail in terms of the coming quarters. Sunil, are you on mute?
Yes, no. Good afternoon. Thank you. I would take this opportunity to update the audience about currently our capacities in full, and we are actually doing 2 major expansion in Pune region for upcoming launches. There are 3 launches planned in Pune region starting from Q3. Q4, they will be phased out. We are also doing the expansion in our Nashik facility. 1 launch, as Mr. Anmol Jain said, already successfully launched and has a tremendous pull in the market. The second launch is just around the corner, and the launch will be revealed by August 15th. I think that is going to be another blockbuster launch coming through. So if you really look at it, the expansion is actually to cater to this growth coming between Q2, Q3, Q4 for the 5 new vehicles which will be launched. And that will be the the growth you will see in future.
Great. This is very helpful. Sir, my second question is on the Lumax Manohar. So, if you can just help me, how much is the current automatic gear shifters penetration? What is the market share of Lumax Manohar in manual and automatic gear shifters? And have we witnessed any further traction in the exports from this entity?
Let Vikas go ahead and answer that, please.
So the penetration of automatic gear shifters has been increasing over the last 5 years. In volume terms, however, it still constitutes around 40 to 45%, but in value terms, it is contributing more than 70% right now. That is due to the higher price between the manual gear shifter and an automatic gear shifter. We continue to be the largest player in this segment in the country by far, with more than 80% market share across all the passenger vehicle customers. The automatic gear shifter also is slated to give way to the monostable shifters, resting on the e-shifter technology that is now transitioning, but that is still 2 to 4 years away, and we are well placed on the R&D roadmap there. Sorry, what was the second question?
Sir, on the exports, how is the traction here?
Yes. So as far as exports are concerned, so each of our joint ventures are India-specific joint ventures, and we are fenced to that extent. Also, because of that, we are not very aggressive on exports in our joint ventures, but specifically in case of Manno, they have opened up the ASEAN market for us to begin with. We have started exporting for one major OEM into Indonesia and Malaysia right now, and the roadmap is now clear for expansion into 5 countries over the next 5 years, as the capacities are getting choked in their parent entities in Japan and other places.
Yeah, this is very, very good news for this entity. So lastly, on the Lumax Cornelia.
I'm sorry to interrupt, sir. Mr. Ahmed, could you please fall back in the question?
Sure.
Thank you. The next question is from the line of Nilesh Shah from Julius Capital. Please go ahead.
Hi, are you able to hear me?
Yes, please go ahead.
Okay, great. Sir, just one small, just one small thing from my side. Can you please just, talk about, your plans with respect to the 2 companies that the group has, which is Lumax Auto and Lumax AlphaStreet. Right. What we see is that the management team, right, and even the client base, right, is common, across them, right? So what are your plans, right? Do you have any any plans to merge them down the road? And if you don't, how do you operate both, right? Both from a KMP and from a client relations point of view. That both firms are able to grow over time. Thank you.
Understood. Nilesh, so thank you for your question. I think this call is more pertaining to Lumax AutoTechnologies, but anyways, I'll give you a quick oversight. I think Lumax Industries and Lumax AutoTechnologies are completely different with respect to their presence in the market. Lumax Industries is a one product, one partner entity which continues to maintain its market leadership in the automotive lighting arena, with Stanley as its joint venture partner of over 40 years. The only lighting which is an exception which we do in Lumax AutoTechnologies is for the Bajaj account, and that is for strategic reasons, and that has been well deliberated and understood by our lighting partner Stanley. Coming to Lumax AutoTechnologies, I think this is a basket of multiple diverse subsidiaries, joint ventures, and the endeavor is to continuously grow and garner a bigger slice of the opportunities that exist with the advanced technologies and the changing landscape of the automotive industry. Auto Technologies is, again, as I said, it has got 9 different joint ventures and subsidiaries which operate under it. Of course, the clients will be common because, let's say Maruti Suzuki or any other two-wheeler big player like a Hero or a Honda motorcycle scooter will continue to be serviced from both the entities. But clearly, both of them do have a lot of synergies in terms of the management team, in terms of the operational synergies. However, they continue to coexist without any, so to speak, competition or overshadowing on each other's spaces. Lumax Technologies remains an extremely different company than Lumax Industries, and that's the understanding that we will still continue to grow both of them separately and individually.
I see. Okay, so your main point is that as you grow, right, you will have the chance, right, to enter new products, new clients, right? So what you are saying is that apart from right, most of these growth pursuits will happen in Lumax Auto, right? Is that the broad idea that I should sort of take away from this? Because what you are saying is Lumax Industries is focused on one product which they will then do across clients, versus Lumax Auto is a multi-product company, and you will do various products with various partners and clients.
That's correct.
Okay. Thank you so much. This really helps. Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Harshil Shah from AM Investments. Please go ahead.
Hello, everyone. My question is for IAC. So what is the content for vehicles on the CXO model? Do you mind the CXO model?
Sunil, could you give that, just what is the value per vehicle on the 3XO? All parts put together, approximately, just I don't know, a range maybe.
The 25%, 25,000 value.
About 25,000 per vehicle value.
And what will be that against like XUV, say something like XUV 700? Is it the content per vehicle higher in case of CXO 7 in case of parts?
No, actually the content, we have our content on 3XO is a little bit less than 700. So actually the content for 700 could be in upwards of 33,000.
Okay, so this is around 25,000. Okay, and my next question is on the can you tell me? You said other subsidiaries will grow at 40 to 50%. So which are the key subsidiaries here that you are considering?
So, Harshilji, this is Vikas Marwa. The other subsidiaries that are slated to now grow at more than 40 to 60%, one, you would see a full year revenue of Lumax Ituran coming in, for which we saw a big traction in Q4. That would be a full year revenue, and it should record more than 50 to 55% growth. ALPS India will also register more than 50% growth in the coming year. This is the ramp up year now beginning for Lumax ALPS. And besides this, the base being small, Lumax Yokowo would be also growing by more than 50%. So these are the three subsidiaries besides ISC and besides the other two joint ventures, Lumax Manno and Lumax Cornalia, which are slated for more than 50% growth.
And just to cut it off, there will be a full year revenue of basically of Lumax Ancillary Limited, so which so far we have considered as a part of our subsidiary. So out of 45 to 50% growth, 20 to 25% will be because of this full year impact of Lumax ancillary.
Okay, sir. And what was the Lumax ancillary contribution in this quarter, sir?
So it was only a 2 months revenue equivalent to 30 crores. So there will be an additional, say for example, 150 crores for the next financial year.
Okay, sir. And sir, connectly with the plastic fuel tank business, can it grow like 30-40%?
So, as far as Lumax AutoTechnologies is concerned, their future two key growth drivers are going to be the plastic fuel tanks and the urea tanks. We are targeting 130,000 volume for urea tanks this year. In our budgeted business plan, we have also taken a volume of 20,000 plastic fuel tanks this year, working with one major customer, which is Tata Motors. We are also hoping that plastic fuel tanks in the commercial vehicle segment moved on to being a regulatory kind of a product, because regulation-driven product then has a higher traction, like you are seeing in urea tanks, which is regulations-driven right now. So, over the next 3 to 6 months, we'll be completely clear on the penetration of the plastic fuel tanks. But yes, it is a big focus area for us, and 24 to 36 months down for Lumax AutoTechnologies, we see 40% of the total revenue of the joint venture coming from the tanks business.
Okay. And sir, any update on the standalone business, like the aftermarket, the Bajaj part? Like, can the standalone business grow by more than 10 to 50%?
Yes, absolutely. I think in my earlier guidance, I did mention that the standalone business will continue to grow at about 15% plus, not just for the current year, but even going forward. I think, as I mentioned, Bajaj Auto, we have made inroads into their electric vehicle platform, which the volumes will start kicking in. Also, we have entered the premium biking space, where the volumes may not be significant, but the value per vehicle is much higher than that of a traditional model, as well as we are in the discussions, how do we get into the Pulsar platform, which is one of the highest selling platforms. So that's on Bajaj. On the aftermarket, as I mentioned, the current year itself, we are looking at anywhere around 20% plus growth. And that's largely because we do see a good offtake in the aftermarket. Yes, cash flow realization still continues to be a bit of a challenge, but I think this growth is coming largely on new products, which we are going to launch in the aftermarket in the subsequent quarters.
Okay, so how much the Bajaj Chetak can add to the standalone entity, Chetak business?
So this year we are targeting round about 15 crore rupees increase coming in from this particular entry. Also, we are happy to share with you that for Bajaj Auto now being a strategic supplier at their Pune location, especially on the EV Chetak platform, we have been invited to come inside Bajaj for their ED coating processes. So the Lumax team is now moving into the Bajaj premises to be doing the ED coating inside the Bajaj premises, which would add also more revenue. It's the first time shop-in-shop concept which Bajaj has initiated with any strategic suppliers, and Lumax AutoTechnologies has been selected for this. So going ahead, this could be a higher traction. It's an absolutely new business model for us.
Okay, sir. And so the last 2 questions. One is on the amount of cash that we are raising, like we are not paying off the debt. So are we looking at any acquisitions? Like, we are always on the lookout for acquisitions. But is it like, have you shortlisted anything? And other question is on the IAC, breakup of IAC revenue, if we can have.
So on the acquisition part, I think, as I've always mentioned, Lumax Technologies always continues to scout for future opportunities which synergize with its core competencies and strengths. As we speak, again, I cannot divulge any details, but yet the company is always evaluating anywhere between 2 to 3 opportunities, which is the current state as well. But again, if something fructifies, we will make sure we, at the right time, make it public. Number 2, on IAC India, you said the breakup. So Mahindra & Mahindra continues to be our largest customer at about 70% contribution to the total pie of IAC India, followed by Maruti Suzuki, and then Volkswagen and Volvo Eicher.
Okay, sir. So Maruti will be around 10, 15%?
Yes, about 10 to 12% would be the share of Maruti Suzuki.
And sir, any scope of Maruti share improving going ahead? Like, have we cracked any model or anything of that sort?
Yes, absolutely. I think we continue to have a order book for the future model at a part and component level supplies for ISA. But I think the endeavor is if we can get into a modular supply to Maruti Suzuki, similar of that what we do for Mahindra and Mahindra. So there are active discussions ongoing, but it may take some time to again be fructified, but I'm hopeful that they are being steered in the right direction.
Okay, sir. That's it from my side. Thank you.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Pritesh Chadha from Lucky Investments. Please go ahead.
Yes, sir. How much will ISC grow in FY25 based on the schedules that you have and the new product line of M&M? And, your margins moved from the first quarter at about 11% to 14%, and there is this ISC merger as well. So if you could tell us the margin range for the Lumax base business X of ISC, and what will be the margin range for ISC?
So on the ISC growth, as I mentioned earlier, we are expecting about a 15 to 20% growth for ISC in FY25 based on the current visibility of the models as well as the volumes. In terms of the EBITDA margins of the let's say without ISC business, we've been consistently hovering at around a give or take 12% EBITDA margin, and we do expect this to grow in the current fiscal FY25, grow in terms of expansion of margins. I would not be able to give you the exact number, but I would perceive that it should be anywhere closer to 13%. In terms of the margins on IAC, I think, again, on a sustainable basis, I still feel that anywhere between 15 to 16% should be a sustainable EBITDA margin for IAC India.
And what was this margin in 25 or 24 for IAC?
For the year gone by, FY24?
Yes.
The margin of ISC was...
So the margin for FY24 was closer to 20%, but there were certain one-time corrections and certain price corrections from the customer during the year. As it was the first year that the IAC India came under the umbrella of a listed entity, so there were certain changes in accounting policies and which were basically suggested by the auditors. So there were certain only you can say that certain amendments and corrections, but way forward the sustainable EBITDA will be closer to 15 to 16%.
So your FY25 combined margin will be most likely lower than FY24, considering this correction?
So as of now, there is no exact number we cannot comment, but it could be somewhere closer to the current year's margin which the company has achieved as a whole, including IAC.
Okay. And on the capacity side, how are you placed on capacities for this growth in ISC and your ex-ISC, the original business?
I think ISC, as was mentioned earlier, that we are stretched on capacities and there are already 2 expansions which are underway, and there is a probably capex outlay of around 50 odd crores for ISC India in FY25. Outside of IAC, I think again it would be too generic of a question because we have multiple product lines and multiple capacity utilizations, but in certain products we would be as high as 80%, and in certain products we would probably be operating at even 60%. But again, to deliver the order book of almost 920 crores As I mentioned, the capex outlay for FY25 for the Lumax AutoTechnologies as a whole would be anywhere between 150 to 175 crores.
Okay. So at least in FY25, you are not constrained by capacity for this 15-20% growth that you're mentioning. You will have the capacities coming up during the year and will be able to suffice the 15-20%.
No, well, we do have capacity constraints, and hence we are investing even to realize the FY25 growth, because almost 20 to 25% of this order book will actually come into the revenue stream in FY25 itself. So there are pockets where we are expanding capacity, and hence I gave a guidance of around 20 to 25% revenue growth for the overall entity at a consolidated level.
Your Lumax growth is 15 and your ISC growth is 15 to 20, and your overall company growth rate is 20-25. So which of the pieces is growing faster there?
I think was mentioned the standalone is growing 15 to 20, IAC is growing 15 to 20, but then there is an aftermarket which is growing at a much faster rate, and there are also the other subsidiaries and joint ventures which are growing at almost 40 to 50%. And hence the consolidated number is more like a 20 to 25% top line growth.
Okay. Thank you very much.
Thank you.
Thank you. The next question is from the line of Neeraj from Lumax Properties. Please go ahead.
Thanks for the follow-up. My question, as you pointed to the last participant, that our subsidiaries and JVs will be growing at a faster pace. So, and as that will happen, I understand the minority interest part in the P&L, it will grow at a faster clip. And over the past few years, we have noticed that that the profit attributable to the company as a percentage split has come down from 85% to 78%. So how should we think about the growth at the attributable profit level?
So, if you see the profit after tax before minority, so now it has settled at, say, for example, closer to 6.5%, which is effectively the 75% of my profit before tax. Now, profit after tax after minority has, say, for example, reduced as compared to previous year. It is mainly because of the higher margin of IAC business as compared to the standalone, profitability margin with respect to this financial year. So going forward in the next financial year, there is a growth in standalone business also, and the profitability margins of the IAC and the other, you can say that the other subsidiaries will more or less stay at a sustainable EBITDA as compared to the current financial year. So the profit after minority will be, say, for example, will be in the line with respect to the 1 year back or 2 years back.
And also there is the addition of the wiring also 150 CR, so that will also add in profit.
Of the standalone entity. Yeah.
Understood. Thank you. That's it.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Amit Hiranandani from SMIFS Limited. Please go ahead.
Sir, on the ISC India margin guidance, so generally 20% what we are doing, so suddenly you're guiding for 15 to 16% due to accounting changes. So can you just briefly explain what is this accounting changes which is actually dropping this margin so much?
So there were change in policy on account of the tooling accounting. Earlier the accounting was based on the POCM basis, basically what is called as the percentage of completion. Now it has been shifted to CCM basis, which is the completion basis. So accordingly, the impact of that has been taken in financial year 24. So it is because of this reason the margins in the financial year 24 were considerably higher.
Understood. And sir, for Q4 EBITDA margin, which is basically, one of the lowest margins in the last 4 quarters. So is this due to drop in the ISC India's margin on a Q-on-Q basis and inclusion of Lumax ancillary?
So, just to clarify, the consolidated EBITDA margin for company as a whole was 14% in Q1, 14.2 in Q2, 15.8 was in Q3. That was, as earlier explained, only due to the certain price corrections in IAC and this accounting policy change, and it is 14.5% in Q4. So across the quarters, the profitability margin has been consistent, and which has resulted into the 12-month profitability margin of 14.6%.
Yes, sir, but if you exclude the other income, so the EBITDA margin for Q4 is 12.1%.
So other income is again due to this certain, you can say that the reversal on account of tooling that has happened in IAC India in this particular quarter.
And sir, what would be the broad outlook if you can give for FY25 and the target for the next 3 years?
So for FY25, as just earlier explained, even if we basically consider the one-time corrections in financial year 24, due to the expansion in margins of standalone entity as just explained by Anmol sir, so we will be looking at a similar margin in FY25 with respect to FY24.
And any aim?
Which will be closer to 14 to 15%.
Any aim for the next 3 years?
3 years would be a little bit far away.
So the 3-year mix would significantly be impacted as the product mix changes. If you see the total Lumax AutoTechnologies product kitty today, and when we say the fastest growth is probably coming from the base that has been small of various joint ventures like Lumax Ituran, Lumax Cornalia, Lumax Ecovo, Lumax Alps. There is a higher penetration of now mechatronics and sensors and switches and EV-related products that's coming. So hard to put a number right now, but for sure we will be on a positive traction going upwards year on year.
I'll just add to that. I think the first endeavor for us was to bring the overall margins at a teen EBITDA level. Of course, ISC India has helped that cause, but also the business without ISC has slowly but consistently moved closer to the 13% mark, and that is our endeavor to try and achieve that and cross that in the coming years. I think apart from that, we are very carefully watching that the order book of almost 920 odd crores, which is sitting on, we are taking those orders fairly at a considerably better EBITDA margin than that of the current entity as a whole. So as and when those order books come into the revenue stream over the next 2 to 3 years, the margins are likely to improve and expand automatically.
Great. Just one last question. Is the group looking to add another product, specially component for electric vehicle, or the first focus is to consolidate and grow the existing subsidiaries?
We are always looking out for future opportunities, not just specific to electric vehicle, but also for alternate powertrain products. It could be in hybrid technologies, it could be in CNG technologies, it could be in other powertrain lines as well. But again, as Vikas mentioned, the focus remains clear in electronics and mechatronics. We see a huge upside with new advanced technologies coming into the future models, and we are well positioned with our current partnerships, and if required, we will definitely create more partnerships going forward as well.
All the very best, sir. Thank you so much. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today's conference call. I would now like to hand the conference over to the management for their closing comments.
Well, I take this opportunity to thank everyone for joining into the call. We will keep the investor community posted on a regular basis for updates on your company. I hope we were able to address all your queries. For any further information, please do get in touch with us or Strategic Growth Advisors, our investor relations advisors. Thank you once again and have a good afternoon.
On behalf of Lumax AutoTechnologies Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.